And now your hosts, Christopher and Jenny, in Making Money with English.
Today we're going to be tackling bond yields.
Oh, yeah.
Those offered overlooked numbers.
Yeah.
They can actually tell us a lot about the economy
Absolutely.
and your investments.
Right.
But first,
Yeah.
a quick shout out to our sponsor, BTMA Wealth Builders Club.
Oh, great.
They're all about teaching people just like you the ropes of trading so you can build wealth and reach those financial goals.
Yeah. And,
Know how English is.
English is a powerful international language.
Yes, it is.
Well, think of finance as another language, one that can unlock a whole world of opportunities.
The whole world.
And that's where BTMA comes in.
Yeah.
Helping you become fluent, so to speak.
Fluent in finance.
If this deep dive sparks your interest in trading
Yeah.
and you want to learn more,
Right.
be sure to check out the link to BTMA Wealth Builders Club in the show notes.
Yes, definitely.
Okay, let's dive in.
Right.
We've got a stack of sources for you today.
Oh,
A
wow.
Wall Street Journal article.
A CNBC video
Uh-huh.
and some expert analysis,
Great.
all focused on the recent surge in bond yields.
What's fascinating here is that these bond yields
Yeah.
are like a heartbeat for the economy. They give
Huh.
us clues about what's going on under the surface.
Okay.
And lately, those clues have been pointing towards some big changes.
Right.
Yeah.
The Wall Street Journal article we've got here talks about
Okay.
a pretty significant jump in 10-year U.S. Treasury yields,
Oh, wow.
almost 40 basis points since the U.S. election,
Okay.
hitting 4.788%,
Uh-huh.
which is the highest we've seen since November 2023.
Wow. That's significant.
But before we get too deep into that,
Yeah.
Hey, thanks for being here with Making Money with English. Don't forget to hit that subscribe button to stay updated. Now, let's get back to the podcast.
can we take a step back?
Sure.
For those of us who aren't walking financial dictionaries,
Right.
what exactly are bond yields?
Yeah.
And why should we care if they're going up?
Imagine you're lending money to the government.
Okay.
That's essentially what a bond is.
Uh-huh.
You give them money, and in return, they promise to pay you back. The original amount plus some interest over a set period.
Right.
The bond yield is basically the return you get on that loan,
Okay.
expressed as a percentage.
So it's like the interest you'd earn on a savings account,
Exactly.
but for lending money to the government instead of a bank.
Exactly.
Yeah.
And just like with the savings account,
Yeah.
when bond yields go up, it means investors are demanding a bigger return for their money.
Okay. That makes sense.
Uh-huh.
Now back to that jump in U.S. Treasury yields.
Okay.
The article points to two main reasons for this increase.
All right.
It mentions something called the upward revision of the Fed funds rate path
Yes.
and a higher term premium.
Uh-huh.
Can we break those down?
Sure.
What does that even mean in plain English?
Let's start with the Fed funds rate.
Okay.
This is the interest rate that banks charge each other for very short-term loans.
Uh-huh.
Think overnight.
Right.
It's a really important rate
Okay.
because it sets the tone for borrowing costs across the entire economy. The Fed funds rate path is basically what the market expects the Federal Reserve to do with this rate in the future. If they think the Fed is going to raise rates more aggressively, then planned bond yields tend to climb too.
So it's like a chain reaction.
Right.
The Fed makes a move and the bond market reacts.
Right.
Now that second phrase, term premium,
Yes.
that's basically the extra return investors want for holding onto bonds for a longer period.
That's right.
It's like a risk premium because with long-term bonds, there's more uncertainty.
Yes, there is.
What if inflation eats away at the value of your investment over time?
Uh-huh.
Or interest rates suddenly spike,
Right.
making your bond look less attractive compared to newer ones with higher yields.
Exactly.
So a higher term premium means investors are getting a little more cautious,
Yes.
wanting a bigger cushion
Yeah.
for taking on that extra risk of holding onto bonds for the long haul.
Precisely.
And the article suggests that both of these factors,
Yeah.
the expected Fed rate hikes and the higher term premium, are fueling this surge in 10-year U.S. Treasury yields.
Exactly.
And it's not just a U.S. thing, is it?
No, it's not.
The article mentions how these rising U.S. yields
Yeah.
are creating ripples in the U.K. bond market, too.
Uh-huh.
It even talks about the Bank of England,
Okay.
or BOE, as the cool kids call it,
The BOE.
possibly having to change its quantitative tightening strategy.
Right.
What's quantitative tightening?
Yeah.
And why would the U.S. market affect it?
Quantitative tightening, or QT, is
Yeah.
essentially the opposite of quantitative easing.
Okay.
Instead of pumping money into the economy, it's
Yeah.
like slowly taking some back out.
Uh-huh.
The central bank does this by reducing its holdings of government bonds.
Right.
Now, when a big player like the Bank of England steps back,
Yeah.
it can push bond yields up because there's less demand.
Okay. So how does what's happening in the U.S. factor into all of this?
Well, as U.S. bond yields rise,
Uh-huh.
they can make UK bonds seem less appealing to investors. It's like comparing two different savings accounts.
Right.
One with a higher interest rate than the other.
Yeah.
Investors naturally gravitate towards the better return.
Makes sense.
This can lead to investors selling off UK government bonds,
Okay.
also known as gilts,
Uh-huh.
pushing their yields up as well.
So it's almost like a global tug of war happening in the bond market
In a way, yeah.
with different countries and investors vying for the best returns.
Global interest rates and investor sentiment
Uh-huh.
can definitely have a domino effect on bond yields across different countries.
Right.
And in this case, the analyst quoted in the article
Right.
is predicting that the Bank of England might have to scale back its QT plans if those UK bond yields keep climbing.
Interesting.
They're definitely keeping a close eye on what's happening across the pond.
It sounds like we've got these big macro trends
We do.
pushing bond yields higher.
Yes.
But let's zoom in a bit.
Okay.
We've got a CNBC video that covers a recent auction of 10-year U.S. Treasury notes. Those same ones we were just talking about?
Uh-huh.
Maybe this will give us a more concrete picture of what's happening in the market right now.
This is where we get to see the theory in action.
Yeah.
The video shows a $39 billion sale of 10-year notes
Okay.
with a yield of 4.68%.
Uh-huh.
The expert in the video calls it an average result.
Okay.
But it's crucial to remember that yields have been steadily climbing,
Right.
particularly for those longer-term bonds.
Hold on.
Yeah.
What does that mean, longer-term bonds?
Think of it like this.
Okay.
There are bonds that mature in a couple of years,
Uh-huh.
and then there are those that mature much further in the future.
Okay.
Like 10-year or even 30-year bonds.
Got it.
Those are the ones we're talking about when we say longer term.
Okay.
The CNBC video highlights something called the 2-10 spread,
Uh-huh.
which is just the difference between the 2-year yield and the 10-year yield.
Okay.
And guess what? This spread has been widening to a new high.
Wow.
We haven't seen it this wide in over 32 months.
What does that widening gap tell us? What's the significance of that?
There are a few different ways to interpret it.
Okay.
One possibility is that investors are getting a bit more concerned about the long-term economic outlook.
Uh-huh.
They might be anticipating slower growth or higher inflation down the road,
Right.
which would make holding onto those longer-term bonds a bit riskier.
So they're demanding a higher premium
Yeah.
to compensate for that perceived risk.
Exactly.
And that's why we're seeing the spread widen.
The expert in the video also points out that the 30-year bond closed above 4.81%,
Uh-huh.
which could indicate a bullish outlook for bond yields,
Okay.
meaning they could climb even higher.
Well, it sounds like there's a lot of uncertainty and volatility swirling around the bond market right now.
There certainly is.
Yeah.
It's like trying to read tea leaves.
Right.
We have all these different factors at play.
Right.
Interest rate expectations, inflation worries what's happening in the global economy,
Yeah.
and they're all contributing to this dynamic environment.
And speaking of the economy,
Yes.
the CNBC expert also mentions some recent economic data,
Mhm.
specifically strong service sector numbers and job openings.
Okay.
How do those data points fit into this bigger picture we're painting?
Well, strong economic data
Yeah.
can actually be another driver of higher bond yields.
Oh, really?
It seems counterintuitive.
Yeah.
But when the economy is doing well, investors often anticipate the Fed raising interest rates to keep inflation in check. And as we talked about earlier, those expectations of higher interest rates can push bond yields up. It's a bit of a paradox, isn't it?
Right.
Good news for the economy.
Yeah, you would think it would be the other way around.
Yeah.
But it all circles back to the Fed's mission.
Right.
They're trying to balance price stability
Mm-hmm.
with keeping people employed.
Right.
So when the economy starts running a little hot,
Yeah.
we might need to tap the brakes a bit by raising those interest rates.
Yeah, tap the brakes.
But hold on.
Okay.
If strong economic data can push bond yields up and higher bond yields mean bond prices go down,
Right.
doesn't that make bonds a bad investment when the economy's doing well?
That's a sharp observation.
Yeah.
And you're right, there is an inverse relationship there.
Right.
When yields go up, bond prices go down,
Right.
and vice versa.
Uh-huh.
It's like a seesaw.
So if someone buys a bond today, and then all this good economic news keeps coming out,
Right.
pushing those yields higher,
Yeah.
could they actually lose money on their bond investment?
That's definitely a possibility,
Really?
especially if they need to sell the bond before it matures.
Okay.
Remember, a bond is like a contract.
Right.
You're guaranteed a certain return over a specific period.
Yeah.
If you hold on to it until maturity, you'll get your original investment back plus the interest payments.
Okay.
But if you need to sell it early
Yeah.
and yields have climbed since you bought it,
Uh-huh.
you might have to sell it at a discount to find a buyer willing to accept a lower return than what's currently available on the market.
So there's a trade-off then.
Exactly.
The potential for higher yields comes with the risk of losing money if you need to cash out early.
Exactly. And that's why it's so important to think about your investment goals and your comfort level with risk before diving into the bond market.
It sounds like timing is everything when it comes to bond investing.
Timing can play a role,
Okay.
but it's not the whole story.
Right.
Diversification is important too,
Mhm.
meaning you don't put all your eggs in one basket.
Uh-huh.
And understanding the different types of bonds out there is key.
Right.
Some bonds are much more sensitive to interest rate swings than other.
You know, this is starting to feel like a whole other deep dive just waiting to happen.
It is.
Maybe we need to dedicate a future episode to bond investing strategies.
Yeah, that's a great idea.
I'm sure our listeners would appreciate a crash course on that.
I'd be happy to join you for that conversation.
Great.
But for now, let's circle back to the current state of affairs.
Okay.
We've been talking about rising yields in the US and the UK. But what about the rest of the world?
Yeah,
What's happening in emerging markets, for instance?
that's a great question. I'm curious about that as well.
They can definitely feel the impact
Really?
when US yields climb.
Yeah.
It makes investments in US dollars look more attractive to global investors.
Okay.
It's like a magnet pulling money towards the US.
Oh, I see.
And that can lead to capital flowing out of emerging markets as investors chase those higher returns.
So it's like a domino effect.
Precisely.
Higher U.S. yields trigger a chain reaction that can influence currencies, interest rates, even economic growth in other countries.
Precisely. And this interconnectedness is exactly why it's so crucial to stay informed about what's happening in the global economy.
Yeah.
It's all linked.
You know, one thing that really stuck with me from that CNBC video
Okay.
was the experts' comment about not getting caught up in rate cut roulette.
Oh, yeah. Right?
It seems like there's a lot of speculation out there about when the Fed might start lowering rates again.
There is. And it's a good reminder that those market predictions are just that, predictions.
Yeah.
No one has a crystal ball. The Fed's decisions are based on a whole web of factors.
Okay.
Economic data, inflation trends, what's happening in the financial markets.
Right.
They're constantly evaluating and adjusting.
So instead of trying to time the market perfectly,
Yeah.
it's more about understanding the fundamentals
Right.
and having a solid long-term investment strategy, right?
Absolutely. And that strategy should be tailored to your own personal goals and your risk tolerance.
Right.
One size doesn't fit all in the investing world.
That's such an important point.
Yeah, it is.
It's easy to get swept up in the headlines and the day-to-day market noise. But at the end of the day, investing is about reaching your financial goals.
Exact.
Whether it's a comfortable retirement, buying a home, or helping your kids with college.
Well said. Those goals should be your compass, not short-term market fluctuations.
We've been focusing a lot on the impact of rising bond yields on investors. But what about the bigger picture?
Okay.
How do these trends affect businesses and everyday consumers?
That's a crucial question.
Yeah.
Rising bond yields can send ripples throughout the entire economy.
Wow.
For businesses, it means borrowing money gets more expensive. This can make it harder to invest in new projects or expand operations.
So it could potentially put a damper on economic growth.
It's a possibility, especially if businesses start pulling back on investments because of those higher borrowing costs.
Right.
And on the consumer side, higher bond yields can trickle down to things like mortgage rates, car loans, even credit card interest rates.
Oh, wow.
That makes it more expensive for people to borrow money, which can impact spending and overall economic activity.
So the Fed is walking a tightrope,
They are.
trying to keep inflation under control without choking off economic growth.
That's exactly it.
Yeah.
They're constantly watching a whole dashboard of economic indicators and adjusting their monetary policy as needed.
Wow.
It's a complex, ever-changing puzzle.
I feel like we've gained a much deeper understanding of the bond market today.
Me too.
It's certainly a fascinating and dynamic corner of the financial world.
It has been an insightful discussion.
Yeah.
And remember, knowledge is power.
Yeah.
The more you understand about financial markets, the better equipped you are to make informed decisions.
It really is empowering to understand how these seemingly complex financial mechanisms work and how they can actually have a real impact on our lives.
I completely agree. And I think it's important to reiterate that we've really just scratched the surface here.
Yeah.
The bond market is vast and intricate, with a whole ecosystem of different types of bond strategies and risks to consider.
So true. It's like we've opened a door to a whole new world.
Exactly.
And there's so much more to explore.
But I think we've provided our listeners with a solid foundation to build on.
Yes, a good starting point to understanding this critical part of the financial world.
Yeah.
So to wrap things up, what would you say is the key takeaway for our listeners today?
I think the main takeaway is that bond yields are on the rise, driven by a complex interplay of factors, including those interest rate expectations we discussed, recent economic data, and those global market trends.
And as we've explored, these rising yields have significant implications for investors, businesses, and the economy as a whole.
Absolutely. We've touched on some of the potential risks and opportunities,
Right.
but it's important to remember that everyone's financial situation is unique.
Yeah.
There's no one-size-fits-all approach.
So what's the best course of action for our listeners who might be wondering how all of this applies to their own financial decisions?
Right.
What should they do with this newfound knowledge?
That's where seeking personalized financial advice can be incredibly valuable.
Okay.
A qualified financial advisor can help you assess your risk tolerance, understand your investment goals, and develop a tailored strategy that aligns with your individual needs and circumstances.
That's excellent advice.
Yeah.
It's always wise to consult with an expert, especially when navigating the complexities of the financial markets.
Yeah.
And speaking of experts, let's give another shout out to our sponsor, BTMA Wealth Builders Club.
Oh, yes, definitely.
They offer a wealth of resources for anyone who wants to learn more about trading and finance.
Yes. Their educational materials and community can be incredibly valuable for anyone looking to enhance their financial literacy and make more informed decisions about their investments.
You can find a link to their website in the episode notes.
Great.
And with that, I think it's time to wrap up this deep dive.
I agree. It's been a pleasure exploring this topic with you.
Likewise. And to our listeners, we'll leave you with this final thought.
Okay.
Consider how these changes in bond yields might impact your own financial decisions, whether it's saving for a future goal, investing wisely, or even exploring a career in this exciting world of finance.
The financial landscape is constantly evolving, so staying informed and adaptable is key to navigating it successfully.
Well said. Until next time, keep learning, keep exploring, and keep diving deep.
Thanks for listening Making Money with English with your hosts Christopher and Jenny. Until the next time, keep learning English and keep making money.